Everybody wants to be a trader, but nobody wants to take the time to study and master the techniques and discipline that's required. If you're willing and ready to make some serious money, you've come to the right place. Welcome to this video. My name is Michael Wang, and in this video and other videos to come in the near future, I will be covering the stories and strategies of successful traders. I'll explain how they made their fortune and what we can learn from them to become successful traders ourselves. So before I dive into today's video, don't forget to smash that like button and subscribe for more content. Please just do it right now before you forget. So going back to the gist of today's video, I'll be talking about a man named Paul Tudor Jones. You've probably heard of this man's name already, so I won't be explaining the petty details of his life story that doesn't really have anything to do with us becoming better traders. Jones became popular in 1987 as a trader during the Black Monday event that took place. He predicted the market crash and multiplied his net worth 3 times and made a name for himself. He appeared in a documentary called Trader in 1987, but he later confessed that he regretted filming the documentary and tried to completely eliminate it from history. But interestingly enough, the full documentary is still up on YouTube and it's worth a watch. So if you guys have time, I highly recommend that you take a look. Let's briefly go over some facts. As of June 2021, Paul Tudor Jones has a net worth of $7 billion. He was born in Tennessee in 1954 and majored in economics at the University of Virginia. And during this time, he was also a boxing champion. Now, traders in the pit back in the day were very tough, and to make it out of the pit as a successful trader required a one-of-a-kind mentality that can be commonly spotted among athletes. So after graduating university, he was introduced to Ellie Tullis, who was a very well-known commodity trader at the time. Tullis hired Jones and taught him how to trade cotton futures. He worked as a trader for 4 years before he founded his own company in 1980, now known as Tudor Investment Corporation. And 7 years later, during the Black Monday event, he accurately predicted the market crash, which brought him a whopping 125.9% return after fees, which amounts to an estimated $100 million. Now, Jones didn't do this alone. Peter Borish, who was Jones's right-hand man at the time, played a very important role in helping him predict the market crash. Borish found a very meaningful correlation between the market situation in the 1920s and the market situation of the 1980s, and through that he predicted a market crash. So if we look at his trading returns, he started off well. He started trading in 1984, and these are the returns he made up to 1987: 136%, 99%, and 200% respectively. So from 1984 to 1988, his total return was 1648% for 4 years, which means that he 17x'd his capital. And then in 1990, he shorted the Japanese bubble, where he made another 87.4% returns. Jones multiplied his money like crazy, but as you guys know, even the best traders can't continuously perform like this for many reasons. First off, trading a few $100,000 and hundreds of millions of dollars is completely different. Also, with the market becoming more automated and efficient in modern times, it has become increasingly difficult to beat the market. So from 1995 to 2004, Jones made an average return of about 18% a year, which is still very, very impressive. And between 2010 and 2012, his annual return dropped to about 5% a year. And then in 2013, his return was about 14.3%. So overall, looking at his career, his annual average return was about 19%, which is 10 percentage points higher than the average annual return of the S&P 500. So this is how you know that when self-proclaimed gurus tell you that making 30% annual returns over a year is nothing, they're full of it. A genius like Paul Tudor Jones made 19% annual returns. So now let's take a look at Jones's trading strategy and method. His trading strategy can be best described by the term global macro. Basically, he is a future swing trader who uses technical analysis and trades all sorts of assets based on global macroeconomics. He famously said that the price leads and then fundamental follows, which is the complete opposite of what value investors normally say. Now, value investors have the philosophy that fundamentals move first and then price follows through later, according to the actual value based on the fundamentals. But what Jones is saying is the complete opposite. And it may be hard to understand what he means by this, but basically his philosophy is that the actual movement in price and price action is much more important than the value or fundamentals. Also, Jones is famous for his contrarian trading style as well. Jones likes to go against the grain and bet on trend reversals. So during an uptrend, he would look for a short position at the reversal point. Now, this is much easier said than done. Some angry value investors might say, there's no way someone can time the market perfectly. But I think that really depends on the perspective. Personally, I think we should look at things from a statistical perspective. So most people say that timing the market is impossible because the probability of someone telling the exact time of the reversal point is close to impossible. But even if you don't get it right all the time, if you can just get it right 6 times out of 10, you can theoretically still make lots of money timing the market. And Paul Tudor Jones is one of those traders. Now, even for someone like Jones, timing the exact reversal point is extremely difficult because shorting or selling the top also means that you might continue seeing losses if you don't time the market perfectly. The Big Short is a great example of this, where people like Michael Burry were right about the direction of the market but failed to time it perfectly. So what did they do? They kept seeing losses after losses until the market actually crashed according to their prediction. So what did Paul Tudor Jones do that made him so different? His strategy was to enter multiple positions with very tight stop losses. So this way he could enter the perfect position at the reversal point. Then the question arises, wouldn't he be losing money if his stop loss keeps getting hit? Well, in order to prevent himself from losing so much money, Jones used 2 methods to complicate his trading strategy. First, he set an absolute stop loss point. So after he loses X amount of money through a number of stop loss orders that get filled, he gives up on that trade. Secondly, every time he gets stopped out, he reduces the size of his position. That way, he's betting smaller positions when he's on a losing streak and bigger ones when he's on a winning streak. From the perspective of capital management, Paul Tudor Jones did not dollar cost average. Once he enters a position, he sets a tight stop loss and refrains from adding further to his position through dollar cost averaging. What's also interesting is the fact that besides stop loss prices, he also set a stop loss time period. This way, when a trend reversal did not take place within his anticipated time period, he would be out of his position. I'll elaborate it further, but Jones relied a lot on Elliott wave theories and market timing techniques using chart patterns. So setting a stop loss in terms of the time period means that if a reversal doesn't take place within his anticipated period, there's a probability that he might have been wrong about the pattern itself in the first place. And besides this, he also monitors risk of his portfolio from a general perspective as well. One of the most important philosophies of Jones as a trader is that he forgets about the bad trades he made in the past and looks to the future. This is one of the most important lessons you guys can take away from this video. The technical stuff regarding Elliott wave theories and his moving average techniques are now relatively common, so they're not as special. But this mentality of his is something that is still relevant in today's market situation. On the surface, this means that you need to forget about your bad trades you made in the past, but on a deeper level, it also means that you need to remain unperturbed whether you are profiting from a trade or losing from a trade. Oftentimes, people get so caught up by the fact that they're either up or down in a certain position, and this makes them either anxious or euphoric. So instead of sticking to their stop loss and take profit levels, they don't stick to their plan and they either cut losses too early or take profits too early at levels where they shouldn't be doing so. And since people are naturally psychologically affected by this, Jones is teaching us not to be swayed by our emotions, but rather to stick to our original trading plan. Besides this, he also gave 3 pieces of advice. First, don't try to be a hero. Let go of your ego and always doubt yourself. Next, don't believe in market conspiracy theories. Don't believe that there is a dark government manipulating the market, because that won't help you become a better trader whatsoever. And lastly, don't think that these so-called economists and finance experts know what they're thinking about. So that is it for today, guys. Paul Tudor Jones was a legendary trader back in the past and still continues his legacy as a successful investor. What I want you guys to take away from this video is that successful traders, regardless of their trading techniques, have a very similar mindset and attitude towards trading. So as we go over more successful traders, hopefully you can figure out exactly what they have in common. Thank you guys so much for watching. Please don't forget to like and subscribe, and I'll see you guys in the next video.